Well, one of the things that we talk about here on the show is certainly the stock market. And, when we get into our retirement, we've got money in a 401k, money in ETFs, money in mutual funds. And it's all, governed by what's going on in the market. And it is funny, Catherine, when I think about people in the market, whenever the market's going up, we go, when's it going to end? And then when the market's going down, how far will it go? Or is this the start of something bigger? And so we're kind of pessimists when it comes to the market. But overall, in a 25-year retirement, we're just going to call it that, a 10% correction happens about once a year. So you may see 20 or 25 of those. A 20% bear market goes down about once every 4 years. You may see 6 of those. And these big ones that we talk about, these declines of 30 to 50%, they happen, maybe once in a lifetime. We've actually seen 2 of those, one in 2000 and one in 2008. So let me ask you about the appetite for risk. When people see that, is like 2008 in their mind and they're like, don't let that happen to me? Or will they take a little bit of risk? How do they feel about risk when they talk to you about it?
Most of our clients are risk adverse, meaning that, they want to take the least amount of risk possible to obtain, to reach their retirement goals. And that's where I think Sam and I really come into play when we sit down with clients, because a lot of times when they're managing their own finances, their 401k, their TSP, their 403b, they just pick a target retirement date fund because someone at work said that's what they should do, or their Lincoln Financial 403b guy said that they should do that. But they don't really have a strategy in mind. They just kind of hope it sticks. And they're just checking it a couple times a year, not really paying attention. They pay attention to the ups and downs in the market on the news, but they're not paying attention on how that affects their 401k. So it's really when they come into the office and they're starting to plan towards retirement, and they sit down with us where we really look at, okay, what are your income goals? What are your goals in retirement? And what's the least amount of risk that we have to take as your financial advisor and as an investor to reach those goals? And that's where we really hone in on, their risk tolerance, and then the appropriate strategies that they need to avoid those, 30 to 50% downturns in the market in those critical years, leading up to when they are going to need that retirement savings for income.
And we also, sorry.
Yeah, go ahead, Samantha.
I was going to say, it's funny, we see people come in and they'll tell us, oh, we want to take as much risk as possible. But then as soon as we do the risk tolerance with them, and the risk tolerance questionnaire has 6 or 7 questions in it, and we go through these questions with them, and then at the end, they realize, okay, I'm not going to be okay if the money drops 20%. I'm not going to be able to sleep well at night. And that helps us get to the point to show them, well, you don't want to take a lot of risk. You are risk adverse. So let's plan based on what the questionnaire helped us find out.
Do you find that playing the percentage game doesn't really make the impact with people, Samantha? When you say, you could lose 20% or you could lose 25% or 30%, and that doesn't mean anything to them. But when you look at them and say, you could lose $450,000 here, does that kind of make more of an impact?
100%. When you show them a $1 million portfolio and show, okay, well, if it's a 30% loss, this is how much you're going to lose. And it's not even that it's going to take that 30% to get back. So a lot of times you lose 30, it takes double to get back what you lost. That in itself scares people. We're not trying to scare people. We're just trying to figure out, are you going to be comfortable if that happens? And also, what are your goals and objectives? Because if you're coming up to retirement and you need to start taking distributions, that's a totally different plan than someone that's 30 years old that has 20, 30, 40 years left for retirement. So really understanding what their goals, objectives, and retirement timeline is.
Catherine, do you find that some of the time when people walk through the door, they feel as though I haven't saved enough and I'm kind of in that runway right before retirement? So right now, I got to really put all my cards on the table, put my chips out there, and I got to have a lot of risk right now, right before I retire, to really run that total up. And that might be one of the worst things I can do.
Yeah, I don't see that as much. I more so see people come in and they've saved for 20, 30 years, and they're have no clue if they've saved enough. I just put money in my retirement because I know that's what I'm supposed to do, but with no real plan in mind other than to squirrel away money for retirement. It's actually what I find the most fulfilling is when I sit down with those clients that have never actually looked at a plan or projected out their retirement over the next, 30 to 35 years, is showing them, someone will say, well, I've only saved, 600,000. I don't think that's enough. I get that a lot. And then I say, okay, well, you don't always need $1 million, $2 million. It depends on how much it is that you need in retirement to live off of and what those goals are. So for someone that, only spends $75,000, $85,000 a year, 600,000 more than likely is enough. It's just a matter of looking at those projections and seeing. And so it's really fulfilling to see their faces when they're like, oh, here I thought I didn't know what I was doing, but, just like the relief, the sigh of relief that they give when they're like, okay, we're going to be okay. Especially with a lot of these federal employees that I've met with over the last year or two, that are taking those early out offers, they're retiring 3 or 4 years earlier than they thought. And then they're like, oh, I'm worried I didn't save enough. I'm retiring 3 or 4 years earlier than I expected. And then showing them the numbers and showing them without being 100% risky, just keeping the same, moderate investments or growth oriented investments and less risk, they could still obtain those same goals, even retiring early. So that's where I see the biggest concerns when people come in is they just don't have a plan.
Samantha, you mentioned that you should be probably at different risk levels. You're not a 20-year-old anymore. You're not a 30-year-old anymore. And they tell us, like a 90-10 or an 80-20 portfolio, 80% risk, 20% conservative as you go through your working years. And then maybe you back that off to 50-50, 60-40, whatever. Is there a place where people kind of land overall that is kind of an average that maybe they flip it and it's 40% risk and 60% in the conservative safe area? Or is it, I suppose it's different for everybody, isn't it?
Exactly. And I was going to say, yeah, there's an average, but I don't like giving the average because the allocation is going to be determined by your goals and objectives. We like to say, or Mike always jokes around, the dog wags the tail doesn't wag the dog. Your goals and objectives are going to determine what your risk tolerance is. So if we have someone that comes in and they want all of their money to go to their kids, they have pensions, they have Social Security, they have their incomes pretty much figured out, and their rest of their nest egg, they really just want to be used to be left to their kids. Okay, we can be a little bit more risky, but if you have someone that doesn't have that income and we need to set aside a bucket of money for income, we need to set a bucket of money aside for fixed income because you're not going to be able to make it if there's a big drop in the market, that's going to be different. So again, I think where we thrive is having people come in and really customizing the plan based on, again, we keep saying goals and objectives, but really what people's goals and objectives are.
One little follow-up on that, Samantha. Let me ask you about the exact opposite of that. We've talked about people who are risk adverse. Do people sometimes come in with a little bit of financial amnesia because it's been a long time since 2008, and some people may not remember the pain of seeing their 401k get cut in half, and maybe they are a little too risky as they walk through your door, and they look like they're 65 when you look at them, but on paper, they look like they're 35.
Oh, we have so many people that come in and they're like, oh, I want to get into Bitcoin. I want to get into this, into this, into this. Well, again, we don't sell Bitcoin. That's not our investment philosophy. But really, it's going to be about what your goals and objectives are. You come in, we'll do your risk tolerance for you. We'll see where your risk is. And then from there, we'll have a conversation of, do we think you need to be more risky? Do we think you need to pull it back? So we see a wide range of people. We actually had a client come in that said he wanted to be 100% risky. We're like, for what reason? There was no reason. He had the income. He didn't have kids. He just thought that was what to do. And after having the conversation with them, he realized he didn't have to put that money at risk. He didn't have to potentially lose 20, 30%. There were other ways to get to his goals.
Mm-hmm. And another event that we saw recently in the markets is 2022. The stock market was down and the Fed was aggressively raising interest rates. And when you aggressively raise interest rates like that, the value of bonds go down. So people that were in those, T. Rowe Price 2025 or, the L 2030 fund, they thought that they were, safe and secure. They had the right balance in their portfolio when really the growth side of their portfolio was down, 18 to 22%. And then the bond side was down another 18% due to interest rate fluctuations. So there's always things going on in the market that you have to plan for. It's not always, like you said, people get an amnesia and they think, the market's always going to go up, or they put a target date fund like that in their 401k, and they think that
Leave it, forget it.
Leave it and forget it. So all of those strategies could be detrimental to your retirement, which is why it's so important to start with a plan. And if you are currently saving for retirement and again have saved 500,000 or more, you need to give us a call to make sure that your goals are being fulfilled by your current risk objectives. 866-597-1040. Again, 866-597-1040.
Yeah, Catherine brings up 2022. That was the COVID drop, and that one went down very, very fast, but it also recovered very, very fast. I mean, within 3 to 6 months, we were back where we were. And if that's your idea of the stock market, I want you to go back a little bit. Think about 2008. It took many of us a couple of years to get back to normal, get back to that level that we lost. So let's not let that happen to you as you're in your retirement years. Let's have a real strategy for risk in the market and find a place that's comfortable for you. Again, our number, 866-597-1040. What does that do? That triggers a phone conversation. We're just going to talk for 15 minutes and say, what is it that's bothering you? What are you concerned about? Have you not chosen an advisor in your life yet? Let's see if we're a good match. It's 866-597-1040 or thesavvyinvestorradio.com.